Good day, everyone. This is Joseph Trevisani from Worldwide Markets. Welcome to another edition of the FX Street webinars. As always, I thank you all for taking the time out for attending. I consider it a great compliment that you do, and I hope the session is interesting, worthwhile, and perhaps humorous, although I hope for that every session, and it's rare that it happens. As always with these webinars, and forgive me if you've heard this before, I know a number of people have been here for several of these, to say the least, over the past number of years. I prefer to do these as a colloquium rather than as a lecture, so if you have any comments, criticisms, jokes, or anything else you'd like to share, please do so. And we will stop and examine what you have to say. Today's topic: is there any other topic in the world of markets and finance these days than what 3 or 4 men and women around the world and their governments are planning on doing with their central banks? Many of us are trained as economists. I'm not one of them. I'm trained as a trader. But our penchant, our interest, my interest certainly, is in examining the state of the economy, its tendencies, where it's going, its influences, and how this affects the markets. From one to the other is not that long a jump. Yet in the modern world, and this has been true for a long time, I'm not just talking about post-financial crisis, the mediator of that transference has always been the central bank. So if 15 years ago, 20 years ago, and Alan Greenspan, Paul Volcker were in charge of the central banks, at least the United States, by and large, most of the time, which mean the same thing actually, the economy dictated the policy. If the economy hotted up, inflation was rising, wages were rising, then the result in central bank policy would be countercyclical. Tone down the tops, buck up the bottoms, give everything an even keel. We are long beyond that world. The one thing I want to say about prognostication in this particular situation where we are now, we all pay a lot of attention to the markets. We all listen and read what people who comment on the market, myself and many, many others who are far more erudite and experienced and knowledgeable than I am. What we think is going on in the market, but more importantly, of course, is what we think will happen in the future. Analysis of past events in the economy is an academic specialty. Analysis of current economics looking to the future is a market specialty, and we are all in some form or other market specialists. The problem we see now, and I speak for myself as much as anyone else, whether they admit it or not, and most of them do not, as a former currency trader in the interbank market for Credit Suisse for many years, up until about 12 years ago, you learn humility. You don't think you're always right. Your trades go wrong. You lose money. And until you learn how to handle that and incorporate that into your trading, you can never be successful. So why do I mention that? When I today I'm going to speak about what I think is happening in the U.S. economy and the rest of the world, I know very well, and this is the point which most people don't dwell upon, that one, my analysis is very likely to be incorrect. It's going to emphasize the wrong things. If I get a general trend right, I'm happy. The world we're in now, with central banks flooding the world with liquidity, with deflation threatening many economies, with declining populations is not a world we have been in before. Anyone who is making adamant, confident predictions about where we're going to be in 6 months, where we're going to be in a year, where we're going to be in 2 years, is not really predicting. What they are doing is telling you the complexion of their own economic assumptions. It's very important to keep this in mind, and this applies to the Fed as well. The Fed, we all need to believe in something. I'm not going to get too philosophical here, I promise. But we all need to believe in something. Nowadays, in economics, we believe in the Fed. At least some of us do. But if you look at the history of the Fed, the U.S. Fed's predictions, as far as inflation and economic growth goes, they've been woefully over-optimistic. The Fed is just as subject to its own biases and its own desires as everybody else. How long has the Fed, the U.S. Fed, been promising or predicting that inflation will return to 2%? 3 years? How long has the Fed been overestimating U.S. economic growth? Well, basically ever since the financial crisis. So the Fed, judging by its own performance, not my analysis, their own performance against subsequent reality, is no more confident and no more able to predict this future, our future, from here than anybody else. This is also a very important point to remember, because as we approach today's meeting, and I'm going to go through some of the specifics in a minute and give you my thesis about where we are. But again, this thesis speaks of my own assumptions about the economy, about how people perform given the current situation. Because after all, what we're talking about is economies made up of millions of decision makers. We're talking about one of my favorite topics, the mass mind. How do people in the aggregate respond? It's a bit like Isaac Asimov's foundation in the history and the science of psychohistory. Using masses of people to predict the future. It's a very famous thesis in science fiction. And he wrote it back in the early 50s when he was a very young man in his 20s. So far, what we've seen is that the American consumers, have not responded the way that policymakers expected. The economy has not responded as policymakers expected. What has responded as policymakers expected? The markets. The only thing that has responded, the only thing that is actually having, where they're actually having an effect, where what they say is what happens, has been the markets, the equities, the currencies, and in the bonds and the credits to some. Those are responding directly to the actions of the Fed. But the economy most certainly is not. Okay, so let's step back. Remember that all of the assumptions that we're dealing with here, mine and everyone else's, are unstated. It's not evident. I'm talking about them here today because I think it's part of the topic that we have here today. But most of the other times when you listen to people on the television, you read what they have to say, very few people write their columns, make their presentations on television, myself included, to incorporate their doubts, to incorporate other points of view, to attempt to account for evidence or statistics that don't back up their case. I'm trying to deal with both sides of it today. But again, I have a point of view. And I'm going to tell you right now what my point of view is as far as this particular topic. Partially I've stated it already, but I'll go through it again, or at least I'll mention it again. The world that we're in now, the economic world that we're in now, is not one that anyone has any experience with. From Janet Yellen and Mario Draghi on down to you and me and everyone in between. Down to my children, if you will, at age 6.5. Nobody has any experience with this world. We don't know the effect of what we're going to do. We are operating in imperfect knowledge and with imperfect theories. The monetarist theory, which is behind much of this liquidity flood, that inflation is always a necessary and monetary phenomenon, is not turning out to be true. Japan has been doing this for 20 years. They are now going completely over the top, shall we say, with their monetary policy. The BOJ is buying 100% of the debt issued by the government of Japan. That's total monetization. Japanese debt is, 250% of GDP, and everyone says it doesn't matter because it is local. Everybody buys it locally. That's nonsense. But what do we see is happening? It's not working. If ever there was a warning sign, it's Japan. But anyway, okay, so where we are now, the central banks and everyone else does not know how this is going to play out. Okay, now let's step back. Today, Janet Yellen, front and center, whole world is watching, everybody's got a screen, everybody's got a market, everybody's got a position, everybody in our world is going to be riveted on basically a kind of white-haired woman who's a grandmother. Somehow that's meant not to be world-shaking, but in fact it's completely world-shaking. She is now expected, and the Central Bank of the United States is expected to take another step on the way to normalization of policy, whatever that means. They're going to remove patience. I mean, if there has ever been such a fuss, there's more fuss over one word than when Moses came down from the mountain with the Ten Commandments. And there were more words in the Ten Commandments. The entire financial world is going to be reading. They've all got all the algo guys have their scanners set up for that text. As soon as it hits their computer, they're going to scan that text for one word. Patience. Is there patience? If there's no patience, they're all going to hit the markets. I mean, this is kind of a odd way to do things, but that's what we're doing. Hold on. Something just came in my display here. I'm just trying to see what it is. I can see everyone who's here, and I can see all comments. So feel free to comment. Okay. Looks like everything's good. I'm going to start with the Fed policy and where they think they are with the United States. That's the chart you're looking at now. Then I'm going to move on to some of the attendant risks, and then I will talk about why the Fed I think is going to do this. Okay, so first of all, U.S. central bank sub-bank rates, as we all know, have been at zero. The zero rate. There's a lot of topics here, so I'm going to try and slim it down so we can focus directly. The Fed wants to normalize rates. It's been talking about normalizing rates forever. We're all getting a little tired of it. I don't think the Fed knows what normalization rate means, but they do know one thing. It's not zero. So we can take that as something which is true. Everybody, I think, on the Fed board, and many, many other people, myself included, are worried that these prolonged, and I mean prolonged, we're talking 6 years, 2008. We're all a lot younger 6 years ago. And we've been dealing with exactly this same issue for 6 years. Gets other things put in, but it's the same issue. The issue really is debt. There's too much debt in the world. What blew up the financial crisis? Debt. What is the European problem right now? Debt. It's soon to be a problem in China. What's the problem in Japan? Among others, debt. All of these governments and all of these societies have been willing to extend their debt. What Greece is saying is that we can never repay this debt. They're absolutely correct. It's the elephant in the room. It's the emperor who has no clothes, whatever you'd like. Greece will never pay that back debt. And you know what? Neither will we or anybody else. Okay. So the Fed wants to normalize rates. In this world, I don't think the Fed has any idea, as I said, what normalization means, except that it's not zero. So from a United States point of view, traditional, or from an American financial Fed point of view, traditional Fed policy, as ordained by Congress, promote full employment, whatever that means, and tame inflation. So what do we know about two things here? And I'm going to go through this chart in a second. By certain measures, and it's a good skepticism. It's good skepticism to question the accuracy of some of the measures that are being used. But by the inflation and employment measures, the Fed has done a bang-up job, finally. Inflation is nil, or very low, 1.6 in the core. Do I have inflation on here? I have another inflation chart. And briefly negative, and I'll probably go back up in the overall, in the headline. And unemployment has been falling. It's now 5.5%, which is close to what most people would consider a full employment. And jobs have been very good as far as the numbers recorded by the government. So the Fed can look at this and say, we're ready, which is what they're saying now. What the Fed wants to do is take patience out because they have, all these words that the Fed has put so much, if you'll pardon me, but ridiculous reliance on. It's like we are casting the I Ching. We are looking to predict the future. We're playing with the Fed's tarot words. These words have no power except what the Fed gives them. So now the Fed, in yet another huge access of focusing on our language because we're not doing anything, has put it on patience. So we're all going to see if patience is there today. The reason I want to take patience out is because they have, not because it means anything. Patience means what? Whatever they say it means. Is because they have given it the meaning, Janet Yellen has and the rest of the people on the FOMC, that if patience is there, we won't raise for a certain amount of time, and if patience is not there, we can raise at any time thereafter. I think they mean 2 meetings. Again, we're talking about the middle of June. There's an interesting point here. Remember I said earlier that because of the situation we're in, no one really has any idea how this is going to play out. And the policies and the opinions tend to be the result of one's assumptions about economies, about the world, about cultures, about humanity, if you will, and how masses of people respond to certain things, all colored by one's own experiences. In my case, my parents were older, not very old, but older when they had children. And so my parents were children during the Depression. And so they remembered this, and this colored their worldview throughout their lives. And I'm sure some of that came down to me. After Janet Yellen being in office for more than a year now, we are back or still talking about a rate increase exactly the same time as when she had that first press conference. Remember that first press conference? I think it was in March of last year. She inadvertently, and everybody was all over the place about it, said it's 6 months after we end QE would be a likely time for a rate increase. And everybody, shouldn't have said that, shouldn't have said, everybody knows what you're talking about. Where are we? 6 months after QE ends, just about 6 months. So her assumption then, despite almost a year and a half of data, has not changed. She and the FOMC are speaking more with their policy prescription now and what they're doing. They are speaking more from assumptions, and the assumption that zero rates are not normal, otherwise they wouldn't be talking about normalization, than they are about the intervening data. So let's talk about the data. The Fed has said 100 times, 1,000 times, they're data dependent. It's clear that the Fed, for more than a year and a half, and probably for a good deal longer than that, the FOMC, by and large, has wanted to raise rates. Is it because the economy is performing so well and they've done their job? Or is it because they are worried, and it's probably both, that the prolonged bout of free money, not only here, but around the world, they're starting to do it again in China, they're doing it in Europe, is going and has distorted the economy? Now, it's a combination of both, but what the Fed has been talking about, and they're focusing on, are the statistics that support their case. And there are pretty much two of them. Now, on this chart in front of you, this is the U.S. economy. There's a whole list of statistics. I could just run down a list I have here. This is courtesy of a site called Zero Hedge. I've got a list of some 40-odd U.S. statistics. Personal spending, construction, jobless claims, trade balance, unemployment, the various Fed surveys, all sorts of them, the Purchasing Managers Indexes, the Atlanta Fed GOP prediction over the past couple of months. The vast majority of these statistics, and I just had to choose a few here, have, one, missed expectations. But expectations tell you as much about, just like the Fed, the assumptions of the author as they do about the degree of accuracy for prediction. So the fact that all of these statistics missed expectations can easily be that the expectations were too high. But there's another standard, of course, and that's the trend, where we are, and that's why we're looking at this here. So what we have here, somehow it's really strange. I walked in here and the mouse is reversed. So anyway, that's really odd. I don't know quite how to do that. So it's like my mouse is like looking in a mirror. If you're trying to cut your hair or something in the mirror, everything goes opposite. Anyway, sorry. Okay, so of this chart here, we have the white is the U.S. manufacturing ISM. The yellow is personal spending. The green is factory orders. The purple is the non-farm payrolls. The red is manufacturing payrolls. And the orange is average hourly earnings year over year. And what we can see if we look at most of these statistics is that there has been a decline of the past several months. There's nothing in the U.S. statistics except non-farm payrolls and the unemployment rate that indicates an accelerating economy. If that's the case, why is the Fed so adamant about normalizing policy? There's even a question on, and in fact, the most important one here from my mind is the orange one right here, average hourly earnings. U.S. economy, as you all know, we've heard 100 times, 100,000 times, 70% consumer driven. If consumers do not have more income, there's only one other way that they can increase purchases and drive the economy, and that, of course, is debt. And if you look at from 2009, and more importantly from 2012 on, the orange line here, there is no acceleration. The average since the end of the recession, in June of 2009, was the last month of the recession, has been 2%. Average hourly earnings. This is the one I keep coming back to. This is the one that you hear, and I saw an article on Bloomberg 2 days ago. 4 charts proving that average hourly earnings and wages are about to accelerate. Well, they don't prove anything of the sort. They're simply evidence that this author has chosen to support their point of view that they expect them to go up. Now, that's a legitimate point of view. But I can do exactly the same thing and prove that they're not going to accelerate. It's, it's Mark Twain's comment, lies, damned lies, and statistics. I'm sure you've all heard that before, probably from me. Statistics can be used to prove almost anything. Maybe not that night is day, but I'll bet you can do that as well. I've just never tried. So, a well-argued case for anything is not one that presents only evidence that it's true. A well-argued case also does its best to account for evidence that does not support its case. And that's something you'll find almost nowhere. And when I write my columns, I do 800 words, and believe me, it's tough to do both. And if you want to make a stronger case, and this is certainly true of television, whenever you're appearing in the media, you only present one side. It becomes a polemical exercise. So anyway, there's nothing in this graph, in these graphs here, that is depicting an accelerating U.S. economy. It's just not there. So now let me look at another one. Sorry, I've got my reverse mouse here, which is really disconcerting. It's a little odd. Okay, now did I put up U.S.? Oh, here we go. Now that's this one. Okay. Okay, here we go. This is U.S. CPI. Okay. Remember, we have the Fed worried about its economic statistics. Primary one before, the Fed's emphasis on employment is relatively new. It was put in by Congress. It used to be called the Humphrey-Hawkins bill. So that meant it was in memory of Hubert Humphrey. So I believe it was put in the 90s. I'd have to check that. This is U.S. year-to-year inflation. Does anyone see any accelerating inflation here? There isn't any. So for inflation, now the Fed has been saying forever, inflation is to come back. Now part of this here, this is headline. Part of this here is energy. No doubt about that. But energy won't reverse but the effect of energy on this chart, energy prices, won't reverse unless energy prices go back up. This is the assumption behind the Fed's core inflation, use of core inflation. That energy prices are volatile. Yes, they are. That food prices are volatile. Well, yes and no. They can be because of harvest. You get a drought, there's an effect there. But the assumption for energy prices that this will reverse because energy prices will go back up is a incorrect assumption. They don't have to go back up. They will go back up eventually, we assume. They always have. One of the reasons that oil prices are so low is directly related to the amount of quantitative easing cash being flung into the world's financial system by central banks. Now, how does that work? A good portion of that cash is just sitting. It's not doing anything. But the cash that is being utilized is looking to earn return. One obvious answer is the stock market. Another answer has been oil prices. Oil prices at $100 a barrel with a moribund European economy, a moribund Japanese economy, a clearly for more than a year now slowing Chinese economy and a very questionable U.S. economy, although better than everybody else. So what was oil doing up there? And with oil up there, what's the effect on the oil market? Well, it makes investment in the oil market a reasonable bet. And so that's what happened. Not the only thing that drove it, but U.S. shale production has been one of the great drivers of supply. Well, what happens when you get more supply? Everyone knows prices go down. So one of the effects and the production of this chart and the impact of this chart has been from quantitative easing. So back to this chart. The assumption behind core inflation is that because it's volatile, its vagaries are random and they even out over the long term. And I would maintain, as the ECB does, that this is self-evidently not true. The collapse in oil prices does not appear at any time soon to reverse, going to reverse. So if it doesn't, then this decline is real. If the decline is real and not going to reverse, then the Fed's issue with inflation is wishful thinking. And as a rationale for raising rates, it's non-existent. And I would maintain that that's the case. As an analysis of the oil market goes, if U.S. shale producers are, just say, take an example, are profitable above 60, what does that mean? Well, anytime the price starts to get near 60, they're going to kick those wells back into production if they take them off, and that will cap prices. The demand for oil has been rising, but it's not been rising because the efficiency of oil is reducing. In fact, the efficiency of oil is rising. That means we use less oil to produce a particular unit of GDP, considerably less, like 25%, than we did 20 years ago. The reason oil has been rising is because it's looking for expanded demand volume from places that are industrializing, China, India, and other places. The assumption is, despite what everyone says about global warming, and I make no comment on that whatsoever, please, is that oil and fossil fuels will be the world's energy source for the foreseeable future. That is what the markets are telling you. Now, you don't have to listen, but that's what they're telling you. Okay, so we're back to the Fed. So the Fed's two rationales, employment and inflation. Inflation is not a factor. The Fed is not going to start raising rates, if they are, because of inflation, because there isn't any inflation. And there also isn't going to be any inflation. Two, unemployment here. You can make a case that the that employment has been considerably better. 12, 13 months of 200,000 jobs, best in 15 years, yada, yada, yada. You can make, there's an argument against that in that the Fed, that the numbers are not accurate. I'm not going to make that argument. I will say, though, and everyone should know, that the BLS numbers of non-farm payrolls are hugely adjusted. The BLS has something they call the birth-death model, in which they attempt to estimate the number of jobs that have been created by small companies, newly founded firms. They add these in to the numbers, and this is what produces the numbers that you see. I can't speak to their statistical methods, and one, I'm not a statistician, and two, I don't know what they are. But just know that the numbers are adjusted. Underneath the non-farm payroll numbers, which everyone pays attention to, is the more important number, which is average hourly earnings, or at least wage income. If wages are not rising, are not increasing, then it doesn't matter how many people are working, or matters much less, let's put it that way. There is no sense in the general economy. In other words, if 200,000 people get a job in 1 month, those are 200,000 people who didn't have income before. They're added to GDP and purchasing power. But if there are 200,000 people getting a job in any 1 month, and even over 2 million, the number of people working is 150 million, 140 million. So any increase in the average wage of 140 million people produces a far greater effect on the economy than the addition of 200,000 jobs in any 1 month. So if you get, and this is why so much attention is paid to this, or should be anyway, if you get a 1/10 rise, if the average hourly earnings per year rise from 2 to 2.4% or 2 to 2.2%, and that is across 140 million working people, that's a huge addition to the economy. If 200,000 people get a job from 1 month to the next, or even 2 million from year to year, the effect is much, much, much smaller. So this line is the important line for me, and not the red line, which produces non-farm payrolls. Okay, so the Fed is not about to raise rates because the U.S. economy is going to hit gangbusters. It's not. Let's take another look here. Let's see if I brought that chart. Yes, I did. Here we go. U.S. GDP. We have the same issue here. The red line is the projection from the Atlanta Fed. I'm sure you've probably all heard this lately. They have a real-time, almost real-time, weekly, I think, update projection of U.S. GDP. Again, this is the Atlanta Fed, not the Fed's FOMC projections, which are uniformly optimistic and have been for many years, and uniformly inaccurate. Just like their CPI predictions, uniformly inaccurate, speaking of their assumptions and not accurate prognostication. So this is U.S. GDP with the Fed's prediction in red, the Atlanta Fed. This also does not give you any picture of an accelerating U.S. economy, of an economy that needs to have higher rates because inflation is coming, because wage inflation is coming. There is no hint of this in any of the statistics. So why is the Fed so bent on raising rates? Before we answer that question, let's take a look at the other factors involved and see where they are. We have the rest of the world. The U.S. is not an autarkic economy, although more so than most large economies, probably the most of all the world's large economies. Nevertheless, it has a major interaction with the rest of the world. The U.S. is actually the world's largest exporter by value, but it's not the most important to its own economy. Many other economies are much more dependent on it. Okay, so does it look like the rest of the world is going to be accelerating, dragging the U.S. along, pushing the Fed for its concern about wage inflation? Let's take a look. I mean, we don't even have to take a look. We can just know if Europe, the EMU, is starting QE. That tells you all you need to know, but I have a chart here anyway, okay? If Japan is monetizing 100% of its debt, that tells you the state of the Japanese economy, period. You don't have to go through detailed statistics. It's there. And we have China. So here, this is what we have here. White is Japan. Yellow, these are year-to-year quarterlies. Yellow is the EMU, green is China. Does anyone see any accelerations here that are going to force world prices or anything to begin accelerating? If anything, you have major concern here. And that's why all of these nations are loosening their liquidity, every one of them. Japan, as I said, is running 100% of government debt into monetization. The EMU is starting its QE. Just by the way, the first week, I think, that they reported from the EMU, remember, the EMU wanted to do 60 billion euros a month in securities purchases. They apparently can't find it. The first week they did, if I remember, 9.8. That means that's 40 billion a month, if that's the average that they keep out. There isn't that much debt outstanding in Europe that they're going to be buying what they want in government debt. And they've already taken care of this. What they've said is they're going to start buying all sorts of other debt if they can't find enough. So the world is no more going to drive the U.S. economy higher than is the U.S. economy itself. So we're back to the question again. What is the Fed up to? And why are they so bent on ending zero rates? And what are the likely effects? Now let's work through this last issue before we come to any conclusions. It seems self-evident by the Fed's own pronouncements, by the Fed's words, by everything they've said, that they do intend to end the zero rate policy. But their ending it is clearly not being driven by economic circumstances. This is GDP in the rest of the world. I don't see any acceleration. When you look at U.S. GDP, do we see any acceleration? No, we see a decline. Let me just tell you, the Fed, the Atlanta Fed's GDP prediction for the first quarter is down to 0.6%. They may not be accurate, but it's surely going to be less than 2%. We're down to 2.2% in the fourth quarter of last year, okay? And this is the Fed, my chosen statistics from the U.S. So the rest of the world is going the wrong way. And you know it, even if you ignore or don't pay any attention to their statistics, you can just listen to their policies. If things were going well in Japan, they would not be doing what they're doing. If things were going well in Europe, they would not be doing what they're doing. If things were going well in China, they would not be doing what they're doing. That's 3 of the world's 4 biggest economic areas. So clearly, it's not the rest of the world. You look at the U.S. Although the U.S. is better than the rest of the world, it has obtained this very modest set of statistics and economic growth with zero rates. Does anyone really believe, including the Fed, that a change in that policy will not have some sort of effect? And then we're back to the question. So why is the Fed, and in my mind, the FOMC has to be, if not terrified, at least worried that the metaphor of drug addiction is true, that the economic result of 6 years running of zero interest rates has so distorted the economy that it's almost like withdrawal if we take it off. Now, is this true? I don't know. And I think it overstates the case. But it has to be a concern. So what can we deduce for the Fed's concerns, which they are not talking about, at least in the most, except in the most elliptical and sort of a referential fashion? The rest of the world is not driving the U.S. to raise rates. As a matter of fact, what's going on in the rest of the world? Everybody's lowering rates. I think last I checked, 24 world central banks, national banks, have cut rates in the past, month and a half. 24. And what's the result of that? Well, one result is the dollar is much stronger. What's another result of that? If it keeps going, the dollar will get even stronger. What's that going to do to the U.S. economy? At least as far as GDP goes, it's going to hurt it. Because two things will happen. U.S. manufacturing will be less likely to sell things overseas, and two, we'll buy more stuff from overseas because it's cheaper. So the GDP report, the GDP effect of this is going to be negative. And if the Fed does, now, right now for today's patients or not patients, my guess is it's pretty much baked into the prices. You're not going to see any great run today one way or the other at 2 o'clock when the Fed, as everyone assumes, remove patients. The only major commentator I've seen out there who doesn't agree with this is Jim Grant. He was actually out there today saying, give him credit for standing up against the crowd. Grant's interest rate newsletter, I think, is his long-time outlet. It's his. He says they're not going to take patients out today. And his arguments are pretty much the ones I've been presenting here. So the rest of the world is cutting rates, is concerned, is certainly not going to drive the U.S. The U.S. economy itself, one, is not performing anywhere near where it could or should be. Two, it is, by its own statistics, weakening. And three, a rate hike or the prospect of a rate hike will have unknown effects on the U.S. economy. But one thing, it's either going to have no effect or a negative effect. It's not going to promote growth. So for all of these reasons, you would think, as far as rationale goes, the Fed would say, hey, we're going to stay on zero rates forever. Clearly, that's not the case. So there is the last item, the one which is difficult to categorize, which goes under the name of normalization, which has not really been, yes, it will affect the stock markets. I think it'll affect the credit markets as well. But it's very questionable. You know, the credit markets have not been responding as well or as predictably to Fed policy as they did in the past. I mean, it's interesting. If you look at the 10-year over the past week and a half, the 10-year has come down from 2.2 to 2.1 at 2.01 today. I wouldn't think it was today. So at the same time, I mean, and all of this has to be worrying to the Fed and the central planners at the Fed. The Fed is getting ever closer to raising rates, we think. But the credit markets don't believe it. The credit markets are looking at the U.S. economy, and they're saying, no, the Fed's not going to raise rates. They're doing their standard traditional analysis. They're saying the U.S. economy is not strong. Wages are not rising. Inflation is not rising. Average hourly earnings are not going up. Many of the useful predictive statistics are declining or have declined in the past 3 or 4 months. Certainly, there is nothing in the statistics, and that's what the credit market is looking at. It's saying, what are you talking about? So even if the Fed does remove patience today, my guess is you are not going to get a big drop in the credit markets. Prices are not going to go down and rates are not going to go up. Everybody in creation, except for Jim Grant, is expecting them to remove the word patience from the FOMC statement today, and prices have gone up in government markets and rates have come down. So that's telling you that even if they do, and I'm assuming along with everyone else they will, that there's a long way from the Fed's removing patience and giving them the freedom that they think they need to operate by their own standards. You know, sometimes I would say the Fed's focus on communication and all that stuff is not particularly useful, and this is one of those. This is not useful to their own policies. This is one of those situations. Okay, so everyone is expecting that they will do this. Does that by any means guarantee? You know, we're going to hear once the Fed gets this out of the way today. No patience. They're not patient. They're no longer a parent. They're not going to be patient. Their kids are grown up. They don't have to be patient anymore. The economy is grown up. We don't have to be patient with it anymore. I know, over the past couple of years, many more children's metaphors have crept into my presentations. Well, I guess that's a natural function. What we're going to hear about for the next several months in the Fed's vaunted, and I think way overstated, communications policy, we're now going to start hearing much more about data dependency. It's going to become the Fed's new theme. And if the economy does not perform, the Fed is not going to raise rates in September. There is zero economic reason for raising rates, except for normalization. Now, let's just talk about normalization for 1 second, for about 2 minutes, and then we will end because we've gotten to the end here. Well, one thing you talk about, if the Fed does raise rates, just to answer your question here, the number of issues I think that will happen. You'll get a stronger dollar. You'll get lower commodities prices. But the largest factor in commodity prices is not the rise of the dollar. It's simply been lack of demand. There is a translation, of course, because almost all major commodities, I think all actually, are priced in dollars. So as the dollar becomes more valuable, it takes fewer dollars to buy a particular barrel of oil vis-a-vis its trading currencies on the other side. But that's not the largest point. It's not one-to-one by any means anyway. The larger factors in the commodity markets are supply and demand, and in this case, demand. One of the things that's true about the entire world right now, and Paul Krugman has been right about this. I disagree with his prescription, but his analysis is correct, is lack of demand. Another thing that this vast amount of funding to support economies, particularly in China, has done, it has overbuilt the productive economy. China has built vast cities that are empty and huge numbers of factories that don't have any buyers for their goods. That's how they kept the economy humming. They're attempting to reverse some of that now and tone it down. But that productive capacity does not have enough buyers in the world. See, the thing is, and I've spoken about this before, you can build a factory in a year, in 9 months, up and running, producing whatever you want to produce. But the market for that, the creation of wealth that spreads out through an economy, creating huge numbers of people who can buy those goods, takes much longer. So you can build the factory in a year, but you don't have enough buyers for 10 years. And this is one of the basic conundrums of the pace of development that we've seen in the past 20 years. The productive capacity has been vastly overbuilt. And one of the reasons is because interest rates for a long time, at least now 15 years, have been held, if you will, artificially low by the central banks. The central banks have been very successful at quelling inflation, or so they think. There are other arguments that you can make that this is a function of the changing makeup of the world's consumers, but that's a little beyond our scope today. So, to wrap up here, the Fed is going to raise rates at some point. They're taking patience out today, and they're not taking it out for any discernible, forget what they say, for any discernible economic reason. Not in the U.S., not overseas. They are taking it out. They are ending it because of normalization. Normalization in this analysis, in the Fed's analysis, I think, they haven't said so, although there are hints of it here and there, means the distortions incurred by having a false price of money. In a capitalist economy, one of the basic ingredients, if I tell my kids when we're building fire, you need three things. You need fuel, air, and heat. Well, in a capitalist economy, one of the basic, if not the basic ingredient in economic growth, which after all means expansion, means building things, is the cost of money. If you want to start a business, what do? You probably go out and borrow money. If you want to expand your business, what do? You go out and borrow money. You want to hire people. You don't have enough sales to support it, but you think you're going to. What do? You go out and borrow money. So one of the basic, if not the basic ingredient in a capitalist economy is money, the cost of money. And what the zero rate policy, now from the Fed's point of view, they're going to say, well, things would have been worse, and this was always say, things would have been worse if we hadn't done this. I can't argue that point. That's another topic. But what the zero rate policy has done, it has distorted the value of this basic ingredient for development. That's, I think, what the Fed means by normalization. That is the reason I think that they are so bent on raising rates. Now, I don't think they're going to, certainly in June. I think it's probably going to be delayed. But their focus, and they're going to say this, you're going to hear a lot more of this in the next couple of months. You're going to hear more of data dependency, and you're going to hear of normalization. It will be interesting to see how the Fed defines normalization. My guess is they are not going to talk very much about the distortions involved in mispricing this basic ingredient in economies, the price of money. What they're going to talk about are historical levels and of interest rates, and transmute them a bit by the decline in inflation. So say they should be lower. We have gotten to the point where I think that the Fed, being in the forefront of all these QE policies, has realized, these are very intelligent people, that the effort to promote, to drive economic growth through excessive use of monetary policies has basically failed. And they know it's failed. Again, failure is defined several ways. One is, did it prevent a much worse situation? Yes, and that they'll say it's an absolute success. But there's another definition, and that is, has it promoted positive change? And I think the result on that is far more nebulous. In fact, I would say it's negative. It has not promoted positive change, and the Fed is beginning to realize this. And this is what's behind. You know, it must be hard for the Fed and its governors to admit this, because they are the heirs of 25 years, of actually more, since Paul Volcker and the success against inflation in the early 80s, of activist, successful central bank monetary policy. And they have now, I think, reached the limits of that policy. And that's what they mean by inflation, by normalization. Okay, folks, I thank you very much for your attending. I hope that this was useful. Let's everybody watch and read the FOMC statement today. We're headed for a very interesting period in central bank policy making, especially by the Fed. I don't think they know where they're going, and I don't think anyone else really does either. Okay, folks, thank you very much for attending. I will put my email up there if anyone would like to. Anyone who's written me email in the past couple of days and I have not responded, I apologize. I've been out of the office. I've actually been ill, and I'm much better now. Nothing serious. And I will answer them all today as soon as I finish this and have some lunch. I thank you all very much for attending. I hope this was instructive. As usual, time for more humor, and I wish you all a very good day. Everyone take care.